Glen Stone, you are Head of Trading and Execution at TreasurySpring, and Arjan S, Head of Sales at TreasurySpring. So Arjan already came and talked in a former, let's say, conference. So guys, let's come back on the TreasurySpring, maybe briefly explain for those who do not yet know what TreasurySpring is. Is it a broker? Is it a platform? Is it what are you? A fintech, and to explain the sort of the underlying products you are proposing, and I guess you will also talk about the guaranteed deposit.
Very good. Thank you, Francois, and thank you everyone for being here. We'll try to keep it short and interesting. My name is Arjan Hess, sometimes referred to by my colleague Glen as AJ. Please don't get concerned. I know who he's referring to. I owe my career and started my career to two bank collapses, BCCI and Barings. The latter, there we go. There's the first laugh of the evening. Thank you. So I got dragged into a brand new concept in the early 1990s outside of France of the institutional money market fund. Then the global financial crisis hit and saw firsthand I was in an organization that lost $1 billion on a money market fund on balance sheet. So I've seen the close shaves and decided after a short pause in technology to join a fintech. To bookend my career and be back on the ultra-conservative end of cash management. And TreasurySpring, in answer to the question, we provide cash managers, corporate treasurers, the ability to build non-correlated investments and the foundations for capital preservation strategies, primarily in repo, repurchase agreements, so secured deposits, as well as government exposures. Glen.
Thank you, AJ. Yeah, so my name's Glen. I've got about 30 years experience, mainly in wholesale banking, particularly in the repo markets. So a lot of that was built around crisis. So, you know, pretty much since my 30 years, banks have been in perma-crisis. So you've done everything from Argentina all the way up to Lehman Brothers, just shy of SVB. So, yeah, there's a lot of history on stage here. We might just run through some of that for you.
Hey, just out of curiosity, and then let me put this slide on straight away. Some of you who like their films may like this a lot. We like the reference ourselves. But Glen, what do you think the biggest focus for treasurers and cash managers should be today?
Well, I think it's interesting, the graphic. There's a great line in the film where Jared Vennett says, "I work for the bank, but I don't think like a bank," and that was in 2008. I think today, for corporates and you know, treasurers aside, I think, you know, they may not work for a bank, but I think they've got to start assessing risk like a bank, particularly in the secured space. But you know, also about from financial resource perspective, I think you know, putting your financial resources front and center in your mind when you assess risk. I think, you know, whether if you're a relatively small organization, that might be cash, you know, that could then start encompassing, you know, sort of bigger organizations or financial organizations, that may well be cash, liquidity, balance sheet, capital, you know, it depends where you sit. You know, banks have lovely ways of explaining this. It's normally macho superlatives, you know, we call these revenue muscles. You know, but basically the idea is to put the resource itself front and center in your mind, and then to look at how it responds to stress or how you protect it. And sometimes there's a cost around that. And, you know, I think certainly for us within TreasurySpring, you know, what we try to do is offer people risk-adjusted returns. They may not be, you know, the headline return. They may be a couple of basis points shy of other products. However, you know, it's a bit like an insurance premium. You know, you do, you know, insure your house against fire damage. You know, if you don't, it's like a total loss. You know, it's kind of a very similar product that we have.
So for corporate cash managers, should those resources be exposed to risk?
What I think is inevitable, I think, most of the cash, it doesn't sit under a mattress. It's going to end up in a bank. There are other products out there. There's money market funds. I think, the product that we offer is another tool in a toolkit. It sits beside money market funds. I think Patrick had a great graphic talking about tri-party repos, which is the primary product that we offer. They have some great characteristics. I think, that they are, I would say, they're not necessarily expensive, but we'll come to that in a minute. But again, they're part of a toolkit that sits alongside other products. But predominantly, a lot of the cash sits in banks. I think we've really got to look at what a bank is, what it does. They are very key in policy transmission for central banks. They're now a lot bigger than they were in 2008, 2009. Lehman Brothers wouldn't even be a GSIB today. The amount of leverage in the system, there's 3.5 times global GDP is loan book leverage. These banks are big. I don't want to run down banks. I was one for many, many years. But banks do fail. In the last 24 years, over 500 banks have failed in the US. Weirdly, most of them fail on a Friday, strangely. However, bank failure is a thing. They are a bit like buses. Pre-SVB, there wasn't a bank failure for around about 2.5 to 3 years. But between 2009 and 2010, over 300 banks failed. In Europe, again, probably less bank failures. However, we have seen a contraction in the amount of banks. There's now about a third less banks today than there was in 2008.
Bank failures, 550 in the US, contraction by a third in Europe. Are banks connected in some way?
Yeah, I think that's fair to say. I think, certainly, living through Lehman Brothers is a pretty rough week. Come to work on Monday, 15th of September, to be told Lehman Brothers is going into default.
So not a Friday?
No, but come Friday, we was having a good hard look at Goldman Sachs and Morgan Stanley, and the thinking at that point was they're not going to survive the weekend. They did succumb to the sort of Fed. They become bank holding companies that weekend, but he's looking at a pretty rough week. But as you see, what's going on there is sort of bank run. They're contagious. Banks are interconnected. They're part of leverage creation. What they're doing as part of policy transmission is they are basically building leverage. They build leverage between themselves. If there's a stress event, there's a real risk that these leverage machines will clam up and effectively break.
So a bank breaking, the system then going into overdrive. Do you think that taking collateral would be beneficial here, going back to repo?
Yeah, again, I think so. Again, the point re taking collateral is twofold. First, you've got the kind of obvious sort of factor on, loss given default. There's some sort of assumptions from the BIS around, sort of how much you potentially can lose in an unsecured claim to a bank. Subordinated claims, almost double those numbers. I think if you're working with collateral, you've got a pretty good chance of not only surviving but thriving in a bank stress event. What we saw, certainly I was in charge of liquidating our sort of equity exposures to Lehman Brothers, and by the end of the week we'd come out with not only a small claim to Lehman Brothers estate, we actually owed them money. We'd actually been sufficiently haircut. We was able to liquidate the collateral at speed in a market which was a little whippy, a little bit difficult to navigate. However, the whole point was, and what we learned very well then, is to pick and choose collateral sets which are negatively correlated to your sort of bank exposure. So it was a really clear lesson that diversification is great, and I think diversification is the primary way you de-risk your book. It gets you away from idiosyncratic risk. But I think the next step in the evolution, is to start looking at how correlated you are to those industries. And, it's very easy to have 20 banks, but they're all correlated. You know, what you want to be doing is, you know, quizzing your banks and your whoever, and making sure that you have exposures which are negatively correlated to those events.
So managing your correlation risk through secured transactions, a repo transaction. We talked about banks earlier that are doing this, but why aren't most treasurers doing it?
Well, I think Patrick had it right earlier on. It's expensive. Historically, it is very, very expensive to do this. You need the infrastructure requirements are exceptionally high. You know that you're running into the millions of euros of cost to do this properly. Trading systems, securities accounts, custodians, operational front office expertise. To get a repo agreement with a bank in isolation, you're probably talking about 1 year's worth of legal work. You don't want one bank, you're going to need a multitude of them. And then, you know, and that's just from the, that's the corporate and that's the client side. If you go to the bank itself, it's even more expensive. AML, KYC, you're probably talking 20,000 euros a year minimum. And 20,000 euros is going to be a profit on a $50 million euro trade. So it is very expensive to do. And then on top of that, you've got all the whole Basel regime costs as well, you know, bank levy, supplementary leverage ratio. It's a hugely expensive business to get into. And I think it's probably never been pushed down to corporates too far because the barrier to entry is so high, and I don't think there's been a regulatory imperative to bring it down to the level because, you know, it's just outside of the realms, or has been historically outside of the realms of possible.
So how do we solve for it?
Well, that's quite interesting. So we have effectively built a new financial instrument which can wrap repo, and effectively. What we are is like a cash aggregator. We're an aggregator, but not a disintermediator. There's been numerous attempts historically to try to break into the bank's sort of repo hegemony, if you like. It is very much a wholesale business. But they not all of them have succeeded because they've tried to take the banks head on. I think what we've tried to do is become a cash aggregator, so we can aggregate for multiple client pools, multiple end users at one time, and then push that money through to the banks or where it needs to be. And effectively, we do that via a tri-party repo. I think we've seen them before, and that has a high level of reliance upon market infrastructure providers like Clearstream, Euroclear, JP Morgan, Bank of New York, and they provide a lot of the risk management services to sit and wrap around this.
So, in summary, TreasurySpring provides you with the ability to place your money outside of money market funds, but to Patrick's slide earlier, in that bottom left corner where everything but yield was high. The reason for that is it's the insurance premium that Glen talked about earlier. You don't insure your house because you want it to burn down, but if it does happen, you've paid your premium. It's that risk that's been removed, which we wrap.
Yeah, I think, you know, again, the cost aspect, I mean, there is a cost aspect to it, and I think it's important to, you know, say sometimes, you know, they may not always compare to quite as good a yield as money market funds. However, you know, the pricing dynamic of a repo is slightly different. It's effectively reflecting the supply cost off balance sheet and resource from banks. So at certain tenors, it can actually generate very, very favorable yields. Certainly within the 90-day period, you could be seeing, you know, ESTR significantly over ESTR returns with a fully collateralized pool of securities sitting behind it. So yes, depends on where you are on the tenor and the ultra short dates. If you want very high grade collateral, you are going to be hovering around ESTR. If you want a slightly wider pool of assets, you know, still over collateralized, negatively correlated, your return over ESTR increases. If you're willing to take some form of limited duration risk, still sub 90 days, you could be doing significantly better than the STR.
So it's not just a diversification, but it's new twin correlation we should all be thinking about.
No, thanks a lot. And so I think it's quite interesting because through TreasurySpring, you give access to a specific asset class that were a bit difficult to invest in because of the documentation, the contract, the fact that you need to open an account at Clearstream, Euroclear, here it's Clearstream. So now you give an opportunity for corporates to get access to a huge range of counterparties, and having deposit guaranteed or not guaranteed. So, but without the heavy documentation. So you have one set of documentation. So I guess that you are, let's say, easing this, let's say, user experience that was certainly one of the most important factors for discourage people to invest in money market fund. And in one set of documentation, you have access to a huge range of counterparties.
Yeah, exactly. So I think for our users, our clients, it's one onboarding. So it'd be one subscription, master subscription agreement. You know, we very much operate similar to a money market fund, however, and then opens up the full sort of product offering. There are 80 obligors available, and there's probably 12 off the 30 GSIBs. We've got 12 of those on a secured capacity now, where you can buy for secured products from GSIBs.
And it's also a curated list, right? There's credit research being done. Maybe the example of Credit Suisse.
Yeah, as I say, we did have Credit Suisse as an obligor, although we did decide to take them down before
a full 9 months before the event, they had been removed.
Yeah. So we do kind of manage the list.
So it's a good way to open, let's say, to other counterparties, to have a good view on the market and what they offer, and also to get potentially some guaranteed deposit, but with a lot of, let's say, an easy way compared to doing that bilaterally and having to define baskets, etc. So, and as you said, if you have, let's say, diversified collateral, so you mitigate even further your risk. So thanks a lot for this presentation. So time to close. You can have more information, and Glen and Arjan will stay with us for additional questions if any, I'm sure.